Classical economics operates on a very straightforward premise. Printing massive amounts of money inevitably drives up prices. This chart shows the U.S. money supply and consumer prices following the 2008 financial crisis. Over a 5-year period, the M2 money supply shot up by 33%. According to the classical rules, prices should have followed suit. Instead, the consumer price index remained practically flat, with inflation staying below 2%. Compare that to 2020. The COVID-19 pandemic prompted another multi-trillion-dollar injection of government stimulus and central bank money creation. This time, the economy experienced the steepest inflation spike in 4 decades. The exact same policy tool was deployed in both crises, yet in 2008, it seemed to defy economic gravity, while in 2020, it overheated the economy almost immediately. To understand why money creation sometimes lays dormant and other times explodes into inflation, we have to look past the physical printing press. We need to examine the mathematical equations that track how capital actually flows and the institutional power struggles that control those valves. This diagram represents the Fisher equation, visualized here as a scale. This is the bedrock mathematical identity of monetarism, written as M times V equals P times Y. The left side of the scale represents total spending. M is the total money supply circulating in the economy. V is the velocity of money, a measurement of how fast a single dollar changes hands in a given year. The right side represents the total dollar value of the economy's output. P is the average price level, which tracks inflation, and Y is real output, the actual physical goods and services produced. Economists recognize a concept called long-run money neutrality. Over long periods, the velocity of money and real output are relatively fixed. They are constrained by deeply ingrained human spending habits and physical limitations on how much an economy can actually produce. Because of these fixed constraints on V and Y, the algebra is inescapable. If you drastically increase the money supply on the left, it must force a proportional increase in the price level on the right. This inescapable math is why the economist Milton Friedman concluded that sustained inflation is always and everywhere a monetary phenomenon. So if the Fisher equation is an ironclad rule of economics, how did the massive money printing of 2008 fail to trigger widespread inflation? Between 2008 and 2013, the money supply grew by an average of 33%. If we assume consumer behavior and goods output remain stable, the mathematics dictate that the United States should have experienced an inflation rate of 31%. The math did not fail. Instead, the economy experienced a severe disruption in one of the variables normally considered a constant, the velocity of money. During the Great Recession, consumers faced immense financial uncertainty. Rather than spending their income, they paid down debts and hoarded cash. Because money stopped changing hands, velocity plummeted to a record low of 4.4. This diagram illustrates how the equation resolved that crisis. The sudden, drastic collapse in velocity completely neutralized the massive expansion in the money supply. Total spending remained the same, keeping prices perfectly flat. The financial system was desperate for a cowbell injection to survive the crash, but terrified consumers simultaneously froze their own spending. Increasing the money supply only drives up prices if that new money actually circulates. When a terrified public hoards cash, their fear acts as a temporary sponge, soaking up inflationary pressure before it can hit the broader economy. The Fisher equation explains the math of inflation, but it misses the institutional reality behind it. Central banks control the money supply, but the government treasury dictates spending deficits. A stable system relies on monetary dominance. Under this regime, the central bank actively adjusts interest rates to keep inflation low. The government accepts these rates and disciplines its budget to ensure its public debt remains manageable. The tipping point occurs when government debt becomes so massive it dictates central bank policy. Economists call this fiscal dominance. In a fiscally dominant regime, the government refuses to cut spending or raise taxes to manage its extreme debt. To prevent a sovereign default, the central bank is forced to generate revenue by printing money and buying government bonds. The central bank's usual objective of controlling inflation becomes entirely secondary. It must passively accommodate the government's borrowing needs just to keep the state solvent. When governments rely exclusively on debt monetization to fund their deficits, the result is extreme inflation, famously documented in countries like Zimbabwe, which eventually abandoned its currency entirely. Argentina provides a textbook modern case study of chronic fiscal dominance. The government has a persistent history of running large budget deficits and forcing its central bank to finance them by printing money. This policy pattern drove Argentina's inflation rate to a staggering average of 190% per year between 1944 and 2023.
It destroyed local purchasing power, forced multiple sovereign defaults, and eroded confidence in the currency. During the pandemic response of 2020 and 2021, the U.S. budget deficit hit roughly 15% of GDP, levels completely unseen since World War II. Simultaneously, the Federal Reserve kept interest rates near zero and drastically expanded the money supply, leading analysts to warn that the U.S. was dangerously flirting with its own fiscal dominance threshold. When the government's power of the purse fully overrules the central bank's power of the printing press, runaway inflation transitions from a mathematical risk to an institutional inevitability. Not all economists view this dynamic as a threat. Modern monetary theory, or MMT, is a controversial economic framework that completely rejects the classical fear of fiscal dominance. MMT makes a bold central claim: sovereign governments that print their own fiat currency cannot go broke. Therefore, they do not need to collect taxes or issue bonds to borrow money before they choose to spend. Under this theory, massive government deficits do not inherently drive up borrowing costs or crowd out private investment, because the government can simply issue new money to clear its obligations. Mainstream economics relies on central banks to control inflation by raising interest rates. MMT argues that raising rates is ineffective, and that controlling price stability is entirely the responsibility of the government's fiscal policy. Under MMT, the solution to inflation is aggressive taxation. The government raises taxes to pull money out of circulation and destroy demand. This model entirely erases central bank independence, treating the Treasury and central bank as a single consolidated entity. MMT offers politicians a deeply seductive promise: the ability to spend freely on domestic programs without worrying about deficits. However, to maintain stability, it relies on a radically untested, highly political mechanism for controlling prices. Unsurprisingly, mainstream Keynesian economists strongly criticize the MMT framework, pointing to severe flaws in its underlying logic. First, critics argue MMT lacks empirical evidence. MMT proponents assert that raising interest rates doesn't fight inflation, yet decades of central bank data and formal economic modeling prove that manipulating the cost of borrowing successfully cools demand. Second, MMT ignores the invisible but highly real constraints of an economy. Variables like the neutral rate of interest and the natural rate of unemployment dictate physical limits on economic output. MMT critics note that you cannot simply print your way past a limited labor force or a lack of industrial capacity. The most lethal critique, however, is grounded in sheer political reality. MMT requires lawmakers to proactively hike taxes during an inflationary crisis to destroy demand. Expecting elected officials to inflict severe financial pain on their own constituents right when the cost of living is spiking is a political death wish. While MMT describes an accounting system that balances perfectly on paper, it completely fails to account for human behavior and political incentives. Without an independent check on the government's spending impulses, it is a blueprint for catastrophic inflation. The mechanics of inflation require us to view the Fisher equation through the lens of institutional power. Aggressive government deficits create a massive structural burden. This physically strains the monetary supply's independence, pressuring the central bank to print new capital to service the debt. Unique historical conditions, like the sudden collapse of consumer velocity in 2008, can temporarily act as a shock absorber, hiding the immediate effects of a surging money supply. But an economy cannot rely on a terrified public forever. Sustained, uncontrolled fiscal deficits will eventually break down the institutional walls entirely, forcing total debt monetization. This leads to a consistent observation. While the Fisher equation tracks the potential for inflation, the decision to sustain those pressures depends on whether the institutional boundary holds or breaks.
history confirms this pattern over and over. From the sudden influx of precious metals in 16th century Europe to the printing presses of modern fiat crises, a massive influx of capital dictates a harsh recalculation of value. Paper fiat currency holds no intrinsic value. It is inherently fragile, maintaining its worth only as long as it remains tethered to strict institutional discipline. This history indicates that long-term price stability depends on a functional boundary between the agency that sets the budget and the one that manages the currency. As global sovereign debt levels continue to climb, politicians will increasingly face the temptation of fiscal dominance. The allure of spending today and forcing the central bank to pay for it tomorrow is a difficult political habit to break. Long-term price stability does not happen by accident. It demands an impregnable, unbreachable wall between the power of the purse and the power of the printing press.